Hey everybody, Einstein here, out from the New York Stock Exchange in Experience Square. What an experience it has been. We've had a crazy day. Reformation, day 2 of its IPO, right? And we're here with Jesse. Jesse's amazing, smartest person on the floor, to be perfectly honest. So one of the things I've been talking with Dan Ives about, and we know Dan. He just separated from Wedbush. He is probably one of the top tech analysts in the world, in my opinion, one of the smartest guys. We've got our own show called Einstein and Ives. He's separated from Wedbush and just started a new investment bank specializing in AI-related things and a new hedge fund, and it's called Yorkville and Ives. And so, Jesse, what we talked about last week was this whole thing. We had a couple of days here where obviously a lot of the Mag 7, a lot of the AI-related secondary, tertiary stocks got hit pretty bad, right?
They did, yeah.
Okay, and the thing that Dan and I spoke about was Capex spending versus monetization. The subject that he kind of brought up was, we know that a lot of the Mag 7 stocks, which are not AI, I mean, they're not real AI companies, but they were visionary enough to know that they wanted to invest hundreds of billions of dollars into data centers and into the AI space.
Yes.
For the first time ever, Google, right, they reported earnings and the guidance showed that they had no free cash flow for the first time in ever, I think, right? And so the question was, well, why did that happen? And the answer was, they invested big time into AI and data centers, and their shareholders are impatient, and they're not getting that immediate gratification that you would get from other investments that they made. And they're all just saying, like, why did we do this? And we know that if in 3 or 4 years, as Dan says, for every dollar spent on Capex, it's going to be worth 8 to 10x.
Exactly.
Their shareholders would have been really angry. Why didn't you invest? Now, while we're seeing no cash flow, they're saying, well, what did you do that for? We could have just stand on the sidelines and not do it. Explain to me if you would kind of agree with that's been one of the pressures on the market, and what are your thoughts on that?
So I think it's a pressure on the market because we're going by an old playbook. And the old playbook was, you have free cash flow, you do stock buybacks.
Right.
We are technology stocks. We don't do stock buybacks. That's okay. We invest in technology and we have growth opportunities.
I love that. Yes.
Google, because you said it,
right,
has their free cash flow has gone negative, or projected to.
For the first time.
Their backlog, however, has increased over 3 times.
And what does that mean? What is backlog?
So what they have for their cloud revenue projected, so where they're spending this money in order to expand data centers, to go on artificial intelligence, they already have the demand for it. They lack the supply, so they're investing so they have more supply. The issue will come if there is a supply and demand imbalance, but there isn't right now. It is a supply problem, not a demand problem.
Okay, and also the bottom line is the monetization part of that puzzle is going to be delayed or deferred.
And that's the backlog, is monetization. Yes,
exactly.
And so that's good, though.
Their shareholders are frustrated and impatient about the fact that, we know that if it takes 5 years to build out a data center, okay, people are not looking at it in a mature sense, right? You have to realize that the buildings just don't suddenly pop up in 5 years.
Correct.
Right? Those regions and those neighborhoods and those cities and those states where we're going to have these data centers their economies are going to be growing exponentially.
And it's already happened where they are.
Exactly.
Yes.
And we know that the president said, you know what, guys, you have to pay for your own grid. So we know there's going to be no drain on that energy thing. At least we are hoping. But we do know that, think about it, it's going to increase employment. It's going to increase, look, the people who are building these data centers are going to have to live somewhere, eat somewhere, work somewhere, shop somewhere.
Absolutely.
And so the whole landscape of the economy is going to become robust and grow. And so while we may not be seeing the immediate monetization of it, as you described, we are going to see it in the future, and it's going to make you all happy, and I just think you need to be patient.
Yeah, and it's showing up in pockets of the economy with increases on construction, job openings. That's a short term, but then that will lead over to more electrical jobs and things like that. So yes, it is very good for the economy. The economy is healthy, then they have more money, and that's why we're seeing a broader based rally. Right now, the S&P 500 equal weight is outperforming the market cap weight, and I think that has a lot to do with it. We have a rotation out of that, but also we have to separate market fundamentals and market mechanics.
Okay, explain.
So market fundamentals are what we've been talking about. The actual balance sheets, revenue, translating over into earnings, forward-looking earnings. When we're talking about market mechanics, it's like what's happening with South Korea. very over-leveraged, or the hedge fund yesterday.
Right.
If you have a margin call or you're over-leveraged, it doesn't mean that the company is bad when there is a massive sell-off.
Right.
It just means you need to raise capital in some way, shape, or form. And usually the capital that you're raising when there is a massive amount of margin calls, it was 1/3 of the population in South Korea. Because they were over-leveraged in South Korea, everyone had a margin call. They also have leveraged ETFs, so that bleeds into the US markets.
Right.
Because we have to balance those ETFs.
Correct.
So if there is a margin call,
Are
a
those
large...
US-based ETFs or Korean-based or both?
Both.
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 Okay. So let's explain that, because their market was down. Dan and I did CNN with Aaron the other night.
I saw
She pulled
that.
out the whiteboard, and they're down 40%.
Yes.
Right? They're one of the largest economies, right? And for them to be 40%, and we know that it actually, the footprint of it was so broad. Like they said, there were little grandmas who were triply leveraged
Yes,
in the AI space.
absolutely.
Like, I mean, that's crazy.
Well, in every downturn, there is one consistency, and that is leverage.
Okay. Wow.
We talked about this the first time we spoke. Remember,
Yeah.
1929?
Yeah.
Leverage.
Right.
Correct.
10-1. Yes.
Leverage. It could be a credit extension,
Right.
but it is leverage in some way, shape, or form. And that's what we mean when fear and greed drive markets. That's the real greed, is you are putting so much money into the market that you do not have. And that's dangerous, because when you have a margin call, what happens is you have to... When you
have to bail, or you have to raise capital to support that thing. It's fascinating, the
It's
components that go into a day, hour of this market. We're seeing moves
so quick.
that used to take generations, right? I have a photographic memory. I can go back to Donald Trump at Davos, Trump 1.0, the first time he was president. He went to Davos for his first economic forum. And for the first time he mentioned, it was when he was getting ready for the whole tariff story. And he mentioned tariffs and China in the same sentence.
Oh,
and the
that's
market
not good.
At 11:14 in the morning, the market sold off 1,400 points. By day's end, we had rallied 2,800 points. We went, by definition, from a bear market to a bull market over lunch. That used to take a generation.
Yes,
to
it did.
happen.
That's
And
incredible.
now it's happening over tea, right? So you know what? Yeah,
It's
look,
technology, though. It's arguably increased productivity on the market in a
Yes.
weird roundabout way. So I do want to talk about the Capex spending and monetization
Okay.
as well. So we've had...
I think we've got 2 minutes.
Okay, we've had a lot of earnings, and we did see a turnaround as well. I do want to
Yes.
attribute that to, if I can say one stock, I know we can't talk about stocks.
Yes.
Not saying it's a buy or sell, just what happened.
Okay.
Microsoft showed us that they actually have a good feel on Capex. They didn't guide as higher. Their
Right.
revenue came in much higher than anticipated, and they showed us a clear path to profitability with artificial intelligence, and that helped raise in sympathy everyone else within the artificial intelligence trade.
Okay.
And I think that was extremely important to this entire narrative, because we needed one of the hyperscalers to give us that information.
Explain to the public, what is a hyperscaler?
So a hyperscaler is going to be your massive mega caps, so the very big companies, Amazon, Microsoft, Apple, Google, those are big companies. Well, Apple's not spending as much, but that are spending on artificial intelligence.
Really?
Yeah.
Let's go with, so what is the definition of hyperscale?
So hyperscalers, so like hyper very quick.
Right, quick and,
Yep,
and big?
scale is getting bigger.
Okay,
Okay.
Gotcha. So it's companies that may not necessarily be in that sector, but they're visionary enough to know they want to be involved in that trade.
That's right.
And so they are in a fast and furious, aggressive way putting money to work in the Capex.
That's right. The hyperscalers are basically the Mag 7 stocks.
Gotcha,
They're the
gotcha,
same thing.
gotcha.
But it's an interesting market. I think there is a ceiling on the market because of geopolitical risk.
Okay.
Until we have that geopolitical risk removed, and we've talked about that 2-year note so many times,
Right.
it still has not come down. The 10 years come down, the 30 years come down,
Right.
the front end has come down. The 2-year has not at all.
Okay.
That's short-term inflation expectations.
Right.
If short-term inflation expectations are elevated,
Right.
it's very difficult to go higher even with record earnings.
And look, we know
That's our
that
ceiling.
We know that one of the big problems with that is the fact that we went from 63.79 in oil,
Yes.
67.39, I'm dyslexic, 67.39 in oil pre-war,
Yes.
to $119.20.
That's right.
We pulled back to 85, went back up. We spent more than 3 months above $85 to $90.
Yes.
And the inflationary implications
Yep.
of oil above $90 is massive.
It is.
A lot of it is in the future.
It is.
We may not even experience the impact that's going to have on us as a country and as an economy for months and months, but we are seeing it in the long-term game.
We are, and it could balance out. But what's interesting is if you look at oil, so oil increases, then the domino effect is, where does it increase? Does it increase on the 2-year yield or the 10-year yield? Short-term inflation expectations, longer-term inflation expectations.
Right.
And what happened is they both went up, but this one went up more.
Right.
And so this one came down. That's a flattening of the yield curve.
Right.
Which tells us stagnant growth. But we've reached
stagnation is something we don't want. Because
Yeah.
There's no secret sauce way or secret pill to get out of that.
Exactly, but that's what to watch. So I'm looking for oil to remain below 90. That's
Right.
extremely important.
Okay.
And the 2-year note to come down.
Right.
The equal weight to keep propping us up.
Right.
And then once the AI trade reignites, and my theory is as soon as we remove that geopolitical risk, which
Right.
is the Strait of Hormuz opening and
Right.
having something solid on the table, then we're going to find new highs. And the new highs were what? June 2nd. June 2nd,
So
76.20.
let's talk about this
Yes.
and this we have to stop. For the last 3 days, normally when we see oil up, we see transports down.
Right.
Obviously, if people are paying, if transports are paying more for oil, it's obviously going to have a negative effect on them. However, over the last 3 days, we've seen a couple of major days of pullback in oil, in the price of oil. We had gone down a lot. We actually even touched that 67.39 level a few days ago, which was a pre barrel oil price pre-war level.
Mm-hmm.
And then we bounced in all respects higher.
Yes.
But we've had 3 days in a row where the price of oil and the transports both went down at the same time. And that's unusual, and I have not been able to figure out why that's happened.
That one, I can't figure it out either. I want to say it's within sympathy, perhaps.
Okay.
But I don't have an answer for you in that one.
Okay, and that's unusual.
And I'm okay saying
'Cause
that.
Normally these things trade inversely. Anyway, you know what, Jesse? It's a pleasure always having you. You help us break this down. This is the Capex versus monetization story here, courtesy of Jesse and the Einstein of Wall Street. We're going to talk about it more and more, unwinding this story, breaking news. We're out of here. That's all I got to say about that.
Bye.
Boom.